It's the afternoon of April the 10th, and this is Rudi Unplugged. The first time in 2024, but hopefully it'll be as educational, as popular and as informative as we envisaged it. I asked for questions and I got a few. I'll try to address as many as possible, of course. To my delight, most questions were about my research into all-weather performers and which companies should be in there, and maybe some should be added. But first of all, a few general comments about the market in general. I've expressed previously I'm not too worried about things that are happening right now. If anyone's interested, it's the bond market yet again, and this is basically normal programming for a market that has now seen quite meaty rises of the lows in October, November last year. Double digits. Now we're gonna get questions about are rates gonna come down and when? Are they gonna go up possibly? Are economies slowing down? Are economies in for a soft landing or not? How strong exactly is earnings growth going to be? And while we are toying with various scenarios, we will get volatility in the share market, and that is only, as I said, natural. That's what happens. As I said, not too worried, but it's always good to have a little bit of cash on the sidelines, of course. How much cash? How worried are you? I'm not too worried. I have a little bit of cash. I'm very confident in where the portfolio sits. At the moment, yes, a lot of share prices are retreating a little bit, even though if you concentrate very specifically, some of them might look a little bit worrisome. But it's actually, I don't think we should be worried right now. Things can change, of course, but for the time being, I wouldn't follow the nervous Nellies into selling too much of my portfolio or taking too many hedges for that reason. Now, coming back to the first item I want to talk about today, it's listed credit, and some investors have been asking whether that is a diversifier and where the risks are. Credit can be accessed in many ways, directly, indirectly via ETFs. We have also the likes of Matrix in Australia, who has two vehicles listed on the stock exchange. The best thing I can say is that in times of rough circumstances, either through the bond market or economically, you will find that credit trades more or less in line with equities. So in a general sense, yes, credit does diversify up until it doesn't. And probably the best way to assess the risks is use the price charts of the Matrix vehicles listed on the ASX. Go back in history, see how they tanked in 2020 and in 2022. And ask yourself, well, is that the type of diversification you want to have? Of course, I don't think we are going to see a repeat of the economic uncertainties of 2020, and we're unlikely to see the bond market uncertainties of 2022. But again, nothing is impossible in these markets, and as I said, you have to assess the risks and make your own decision whether that is the diversification you like to have in your portfolio. Now, coming to all-weather performers, I wrote quite an extensive story this week, of course. I hope I did answer quite a lot of questions with that. There's always questions that remain, of course. I think the most important point to make here is that when I try to identify all-weather companies, and those are basically companies that are much better suited than the majority to deal with challenges and to make sure that they can create value for shareholders. It's important to note for everyone who tries to understand what I'm trying to do here is that my research does not take into account share market momentum. And that, I think, for most investors, if I relate to the questions I'm getting, for most investors, that's the part that's the most difficult to understand. And when my research got pretty popular from 2015 onwards, and in the first instance, a lot of those stocks that I identified at the time, think of Ystag, of Altium, and the likes, they actually got picked up by the market and they had quite strong momentum. But that's not the reason why I picked them as the more quality companies in that new emerging type of companies on the stock exchange. I picked them because of what they represented operationally. The fact that the market then picked them up and started running away with them, that's a complete different, that's the financial market doing their thing. What I'm trying to tell you here is that when momentum goes away and temporarily goes elsewhere, that doesn't mean that those companies that I identify as all-weather companies, that they all of a sudden lose their status. Things have to change quite dramatically for companies to lose their status as an all-weather. And the most obvious one I can probably throw in here is Ramsay Healthcare. When I started my research post GFC, I thought at the time that Ramsay Healthcare would deserved to be put in the same basket as the likes of CSL and ResMed Cochlear and REA Group, Car Group and others. And for many years that proved accurately. Ramsay Healthcare for a very long time was a very solid, dependable performer in on the stock exchange. But that changed at some point, and I think that label should no longer be attributed to Ramsay Healthcare. And you see it also. I mean, things have changed dramatically, and sometimes those things are easier to highlight in hindsight than they are in foresight. Nevertheless, things do change, and on occasion, companies that have performed well in the first decade of my research, they no longer are part of that group, or we just should accept that there's a pause in the uptrend. And whether that leads to the fact that they are no longer considered an all-weather is maybe there's a little bit of personal bias in there. But I try not to have that, and I try to assess that on the fact that sometimes in hindsight it's easier to identify that what drove the strong performance over the first decade is no longer there after that first decade. And equally so, I just mentioned stocks like Altium and Ystag. They are part of a growing new segment on the share market, the tomorrow's future, which is much different from yesterday's past. And because we are going through that transformation in economies, a lot of those companies that used to perform well, they now have extra challenges and headwinds, and that might sometimes be a little bit too much to deal with. And for that reason, I recently also removed MCOR and Brambles, and those things have all been published, so I'm not telling any secrets here. Now, going briefly through my my selection of all-weather performers, I think we at the moment we have three groups and roughly taken. And the first group is the likes of let's say Hub 24 and Goodman Group, Car Group, REA Group, Quarry. They're not all weathers, but they also include what I believe are the more quality companies in those new segments on the share market. They have strong momentum, which you can see from price charts. I do think maybe the more flimsy one here is Macquarie, which is if we go back to the reporting season, it wasn't that great. But the share price is carried by the fact that we are anticipating, we as a community, the revival of M&A globally and also in Australia, and Macquarie is simply being identified as the major beneficiary of that new trend, of that revival in that trend, and that's why the share price is where it is and carried quite strongly. The ones that have my attention are Hub 24 and Goodman Group. Both were very well positioned, very well managed. They have very strong momentum operationally, and there is, I can attest to that, there is a growing anticipation amongst analysts who cover those companies that the upcoming quarterly updates will prove strong as well. And that's what you basically see in the share prices. So I wouldn't expect those share prices to come off, if anything. And of course, all shall be revealed in those quarterly updates. But as I said, I'm not too worried, even if there would be a little bit of a stumble in any of those of the updates. I think often it's easier to make longer term forecasts than short term. And on my longer term forecasts, carried also by all those analysts who cover those companies, there's no cloud in the sky, essentially. The only thing you can be unhappy about here if you don't have them in your portfolio. Now there's a second category of all weathers, and we are, I think, we're very well aware of that. Not everyone has performed strongly in recent times. CSL would be the most obvious one there. But it's worth highlighting that an earlier phase, Morgan Stanley saw a path to a $400 share price. Macquarie this week has responded by saying they can see a $500 share price. All good and well, but obviously we don't see that in the share price at this point in time. Again, the loss of momentum in the share market is not necessarily reflective of what is happening operationally, and I think operationally will continue on a very strong pathway for CSL. It's an 80-20 story, I believe. The 80% that's performing well is what we should be focusing on as shareholders, and the 20% hopefully that corrects itself. If that scenario unfolds, then I believe those scenarios painted by Morgan Stanley and by Macquarie, they have a good chance of materializing. As I wrote this week, impatience is every investor's worst enemy, and sometimes we just have to accept that share prices don't move, even though there's lots happening on the operational side for those companies. We have also, in the selection, as is usually the case, we also have a few laggards, and those laggards, I think at the moment, would be amongst the smaller cap, emerging business models. IDP Education has now been lagging for quite a while, and is probably already halved from where it was at one stage. I don't think that business model is shot to pieces. I think it's purely uncertainty about what governments in Canada and in Australia, predominantly the UK, what they are up to with immigration and with students. That uncertainty is simply being used by hedge funds to try to trash that share price, basically, and try to get it as low as possible. This will turn around at some stage, just like it once upon a time did with ResMed, but pinpointing the exact point is very, very difficult, because the uncertainty at the moment is just overwhelming just about everything else, and that's just what it is. I mean, Mohammed can't move mountains at times, and this is one of those times. So it's everyone's choice whether you decide to be patient here, or you simply think, well, I don't have the patience, and I move elsewhere, or maybe you weren't there in the first place. The portfolio that I manage has luckily acknowledged that the uncertainty is here to stay for a while. So we have kept it in portfolio, but it's not a large allocation for the time being. The other one, of course, is Woolworths. I think, and I've expressed this view previously, I think investors should start by identifying the better quality companies on the stock exchange, and from then onwards it's much easier to identify true opportunities. I think this whole political malarkey about the supermarket operators is just that, and ultimately, just like with ResMed previously and with IDP Education, it'll resolve itself. In the meantime, there's dividends, and if the market gets a little bit volatile, there's always a defensive impact that will work, I think. So, needless to say, the portfolio I manage has bought more shares in Woolworths, taken a longer term view, and just taken the short term uncertainties and bad press on board for what it is essentially. Now I can't go through all the suggestions made whether this stock should be in and the other stocks should also be included, but what I can say is that when I select all weathers, I do pay attention to the track record, and the track record is often visible on price charts. I mean, if you open the price charts for the past 2 decades, you can see that REA Group, Technology One and the likes, and some of the companies I just mentioned, you can see that ultimately management did deliver, and those share prices are now an all-time high. For a lot of other companies, that is more something that happened in recent times, and then of course, again, if they have a few years in which they are successful, does that by definition make them an all-weather? My answer usually is no, it doesn't. And that's where I think, if you want to get into the spirit of what is an all-weather and what isn't, it's not always that easy, and I do see most suggestions coming my way pretty much relating to companies that just having a good time right now. And that makes you wonder how much that good time will last, of course. One of the more intriguing suggestions that was made to me is whether the Magnificent Seven in the United States, whether they by definition would be all weathers. I don't research the US as I do Australia, but my answer of course is no, because I just gave you the answer that just because a few companies have a good time for the time being, that doesn't mean they are an all-weather. An all-weather means you perform and perform and perform, and as I said, I mean, the likes of CSL, they've performed over more than 2 decades now. That's what makes you an all-weather, not 2, 3, 4, 5 years. Having said so, it's an intriguing question, because if I were in the US, I would probably have decided that Microsoft is an all-weather stock, and I can also tell you that I probably would not have liked the likes of Meta. I would be sitting on the sidelines as far as Apple goes, but I would have recommended owning Nvidia for the same reason as I am very much a big fan of the likes of Goodman Group and NextDC and Dicker Data here in Australia, because what I have, as those who are familiar with my research know, what I have tried to do is not only identify your typical all-weathers, and there are not that many, but I've also identified that we are going through a significant innovation, renovation, disruptive and innovative era of technology and change, and that brings along with it new winners, new business models, and if you can identify the quality ones in that new wave of companies, then obviously that can be very profitable as an investor. So my equivalent of the likes of WiseTech here and still REA and Cargo would be Nvidia in the US, and of course plus others that are specialized in data centers, in cybersecurity and the likes. One company I can reveal here is one company that always has fascinated me, and I would definitely consider that as an all-weather, is MSCI, and most investors would be familiar with it because it does all the indices globally. It's not a spectacular performer, nowhere near what the likes of Microsoft and Nvidia do in the US, but here's the point. As an all-weather, it doesn't have to be spectacular, and I think that a company like MSCI, which has all the indices and everything related to it, and has a tremendously strong market positioning, as long as it performs year in, year out, which I think that's the type of company that we're talking about here, it doesn't have to be spectacular, but that is the characteristic of an all-weather. Now, I do realize I haven't addressed all questions here that came my way, but that's a little bit impossible. I don't want to make this too long either. It's the first time in 2024, and we're going to do this again. I will go through the questions after this and see whether I maybe can address some of them in my writings. And otherwise, I can only say, do send in more questions. I hope you liked the first time. We'll obviously looking for improvement in all the other times that we're going to do this. And for the rest of it, I hope you still like my research. You still like these updates. I will do my best in addressing your questions, and we'll do this again next time. Thank you.